So on Tuesday, June 9, 2026, we did something kind of fascinating. We took 10 tabs of live allocator-grade market data.
Right, the real heavyweights.
Yeah, exactly. Stuff from FinViz, Yahoo Finance, Reuters, the actual terminal data, and we fed all of it into the world's most powerful AI models.
We're talking Mistral, Copilot, ChatGPT, Claude, Gemini, Grok, all of them.
All of them looking at the exact same numbers. But here's the wild part. Half of them concluded that the economy is in perfect, booming health, and the other half are flashing these catastrophic code red warnings. So today's deep dive is all about figuring out which machine is hallucinating and which one is actually seeing the truth.
Yeah, it's the absolute definition of diagnostic muddy waters. I mean, you feed identical inputs into these large language models, and they just spin up two totally incompatible financial realities.
It's crazy.
There really is. You cannot mathematically have a market that is simultaneously euphoric and terrified. Yet that is exactly the split we're looking at today. And for you listening, we need to sort this out so you don't get caught off guard.
Okay, let's unpack this division first. On one side of the room, you've got Copilot, Gemini, and Grok, right? And they are just screaming that we are in a confirmed risk-on environment.
Right.
They are pointing directly to the macro foundation. It's like consulting a team of doctors where half say the patient is ready to run a marathon.
That's a great way to put it, because those specific models, they are fixated on the credit and rates markets.
Yeah.
Like Copilot and Grok are highlighting the MBE index.
Which measures bond market volatility.
Exactly. And it's sitting at a completely sedated 77. There's literally zero panic in the bond market. And then you look at high-yield credit spreads, the HYOAS is just pinned between 2.74 and 2.76%.
Wow, that is tight.
It's the 9th percentile of historical tightness. Credit lenders are entirely unbothered.
And Gemini even threw in a fundamental kicker, too, right? It highlighted this massive 27% year-over-year earnings growth for the S&P 500.
Yeah, so if you're an AI model that's weighted to favor, traditional valuation metrics and plumbing stability, you look at this and say everything is fine.
Right, but then we have the other side of the room, Claude and ChatGPT. They parse that exact same terminal data, and they immediately classify the environment as a risk-off regime.
Total panic mode.
Yeah. They completely ignore the calm in the credit markets and hyper-focus on this catastrophic internal breakdown happening under the surface. And this is where we have to establish the stakes for you, the listener.
Right, because if you are managing capital, you can't straddle these two realities.
You really can't. If Copilot is right, you should be fully deployed in growth and tech. But if Claude is right, you need to be aggressively hedging.
So we really need to look at the specific data points that Claude and ChatGPT are so terrified of. And they're looking straight at the terminal screen divergence.
The E-mini S&P futures, the ES?
Yeah, if you pull up the ES, it's only down a microscopic 0.24%. I mean, it looks like a completely flat, totally irrelevant session.
Barely moved.
Right, but Claude and ChatGPT are looking underneath the hood. The NASDAQ 100 ETF, the QQQ, is down 1.15%. And the broad tech ETF, XLK, is bleeding 1.85%.
Okay, wait, hold on a second. I have to push back on the AI's logic here.
Okay.
If the broader market, the ES, is only down 0.25%, how can half these models claim we're in a fear regime? I mean, a 0.24% drop is literally a rounding error. What is actually breaking to trigger their alarms?
It's the volatility complex. They're picking up on the VIX, which is hovering near 20. It printed at 19.87 on the terminal. And the broader fear and greed index has officially tipped into that fear regime, stuck in the 33 to 43 range.
Oh, I see.
Yeah, so the models focused on equity options flow are seeing a completely different landscape than the models focused on corporate credit.
Which introduces our first major structural contradiction. We need to figure out who is lying here. Because we have high-yield credit spreads euphoric at 2.74, saying everything is fine.
Right.
But then equity volatility is pushing 20, which says something is actively breaking. So if you are an allocator, who do you trust?
Well, historically, the credit market is considered the smartest guy in the room.
Yeah.
Bondholders sit higher up in the capital structure, so they are literally paid to obsess over downside risk.
Bankruptcy probabilities, that kind of thing.
Exactly. So if credit is calm, conventional wisdom usually says the equity guys are just being hysterical. But, and this is crucial, there is a mechanical delay built into credit.
Right. It's a slower moving instrument, isn't it?
Considerably slower. Credit trades over the counter, it's less liquid, and it reacts to lagging fundamental data. Equities, though, and specifically equity options, they are hypersensitive.
They react instantly.
They react to real-time liquidity conditions. So given the sheer scale of the internal selling in tech right now, the equity market is telling the truth first. It's functioning as an early warning system.
So it's pricing in a shock that credit just hasn't registered yet.
Okay, but if the credit guys are popping champagne, what exactly is the options market seeing? Because surely if equities are panicking, the bond volatility index must be reacting too. And that brings us to the second massive contradiction. We already established the movie index, the rates volatility, is totally calm at 77.
Fast asleep.
Right. But look at the volatility of equity volatility. Look at the VVIX.
Yeah, I saw this. The VVIX is up almost 3.7% today, hitting nearly 96. And the skew index is elevated above 141. So, think about it like this. The VIX is your speedometer, right?
Okay, I like that.
And the VVIX is the tachometer. It measures the engine's RPMs. So you look at the speedometer, the VIX, we're only going 20 miles an hour. It doesn't feel dangerous at all.
Barely moving.
Right. But you look at the tachometer, the VVIX, and the needle is completely pinned in the red. The engine is absolutely screaming. So the car isn't speeding yet, but this is a stealth hedging operation.
That is a perfect analogy. That structural setup, calm rates volatility paired with this screaming vol-of-all, is the classic pre-vol expansion signature.
Wow.
Yeah, it reveals exactly what institutional players are doing behind the scenes. They aren't dumping their massive portfolios in public yet because that would crash the market.
And destroy their own prices.
Exactly. Instead, they are quietly buying massive amounts of out-of-the-money put options to protect their downside.
And when institutions buy that much crash protection, it forces the options dealers into a corner, doesn't it?
It absolutely does. The dealers who sell those put options now have all this massive downside exposure. So to hedge their own books, they have to short the underlying futures.
Right.
And as the market ticks lower, their exposure grows, forcing them to short even more. It creates this mechanical doom loop. That is why this QW is over 141. The smart money is buying hurricane insurance while the sun is still shining.
Which perfectly explains why Claude and ChatGPT are flashing code red despite the S&P 500 looking flat. They see the underlying plumbing preparing for a violent move.
Exactly.
But there is a third contradiction we pulled from the terminal today that completely validates this fear regime, and it's happening in the commodities market.
Ah, yes, the gold canary. Gold futures, the GC ticker, are down hard today, dropping 1.89%. And this is happening at the exact same time equities are selling off.
Here is where it gets really interesting to me. Traditionally, that is entirely backwards. If people are scared of an imminent stock market drop, shouldn't they be buying gold as a safe haven?
You would think so, yes.
Especially since the US dollar, the DXY, is completely flat today. So it's not a strong dollar-crushing gold. Gold is just bleeding out on its own.
Right, and when gold sells off violently at the exact same moment risk assets are dropping, you are looking at a forced deleveraging signature.
Okay, walk me through the actual plumbing of a margin call here. Because if I'm a massive hedge fund, right, and I'm bleeding out on my high beta tech positions, how does that systematically force me to dump my gold?
Okay, so if you're running a levered fund, you have a strict value at risk, or VAR limit.
Yeah.
When your tech heavyweights, your semiconductors and software names start dropping rapidly, the volatility of your portfolio spikes.
Okay, makes sense.
Your prime broker's risk system automatically detects that your VAR has breached its limit.
Right.
So the broker issues a margin call, demanding you post more cash collateral immediately.
Wait, but I'm fully invested. I don't have the cash just sitting there.
Exactly. So you have to raise it instantly. You don't want to sell your tech stocks at the absolute bottom, and frankly, there might not be enough liquidity to absorb your massive block of shares anyway without crashing the price further.
So what do I do?
You look across your portfolio for your most liquid, profitable asset. You sell your winners to fund your losers. You sell your gold.
Wow. So this isn't a macro rotation at all. It's just survival.
Pure survival. Funds are being physically forced to liquidate their safe havens just to keep their heads above water on their bleeding tech trades. And that dynamic tells us the pain under the surface of the stock market is acute enough to trigger systemic VAR shocks.
Which brings us back to the primary mystery, really. Now that we know forced selling is happening, how did half of the most advanced AI models on Earth completely miss this?
It's a great question.
I mean, Copilot, Gemini, Grok, they misread the environment drastically. What were their blind spots?
They fell victim to the illusion of the index. And this really addresses your earlier point about how the E-mini S&P can be down a mere 0.24% while the internals are collapsing.
Right, so think of it like a massive cruise ship. The top deck, those mega cap tech names, they are totally dry. They're up there having a party, keeping the overall index elevated. But the lower decks,
The lower decks are taking on water rapidly. If you look at the terminal breadth data, you have 1,341 individual stocks hitting brand new lows on the New York Stock Exchange today.
and the tech side is even worse.
Much worse, 2,754 stocks hitting fresh lows on the NASDAQ. It is a catastrophic collapse in market breadth.
2,754 companies hitting rock bottom in a single session. The pumps are failing, but the AI models only scan the headline index price, so they think it's a beautiful day to sail.
It's classic late cycle distribution. The heavyweights at the top act as a structural facade. Because these indices are market cap weighted, a handful of trillion-dollar companies dictate the headline number, completely masking the rot underneath.
But eventually, the water reaches the top deck, right?
It always does. Because there is a broader structural reality driving this breadth collapse. The AI models hyper-focusing on credit completely missed a massive phase shift in real market liquidity.
You're talking about quantitative tightening, the Fed's QT program?
Exactly. We've been under QT since 2022, but the stock market largely ignored it for years.
Why is that?
Because the system was loaded with shock absorbers. Previously, institutions just pulled their excess cash, parked at the Fed's reverse repo facility, the RRP, to absorb the impact of QT. The actual stock market was completely insulated.
But the data today confirms that padding is gone. The RRP is functionally exhausted, right?
Yes, the excess liquidity has been drained. And at the same time, the Treasury General Account, the TGA, is elevated. We have transitioned into a zero-cushion reality.
So let's follow the mechanics of that. If the RRP is empty when the Treasury issues new debt now, who buys it?
Primary dealers and banks have to step in. But since they can't use excess RRP cash anymore, they have to use their actual reserve balances.
And that drops the capacity for leverage in the financial system.
Exactly. The liquidity drain bypasses the shock absorbers and hits the equity markets directly. Every dollar the Fed destroys now comes straight out of risk assets.
So, synthesizing all these blind spots, what does this all mean for the credit markets? We have terrible market breadth, forced deleveraging, liquidity draining, and yet high-yield credit is still sitting at 2.74%.
The rubber band is stretched to its absolute physical limit. You cannot sustain extreme equity fear and extreme credit euphoria simultaneously.
They have to converge.
Right. To resolve this tension, either the VIX collapses back down and thousands of broken stocks catch a bid, or credit spreads have to widen violently. And given the terrible breadth, widening credit spreads are highly likely.
The bond market is going to be forced to reprice this risk. So with these blind spots exposed, we need to label exactly what kind of market environment you, the listener, are navigating today and how to position for it.
If we connect this to the bigger picture, we know what this isn't. It is not a systemic crash regime.
Right, and it's not a true recession either. The AI models weren't wrong about the 27% S&P earnings growth. The broader economy hasn't collapsed.
Exactly. It's precisely a transitional regime. We have a positive macro and credit foundation colliding with a violently negative equity impulse. It's a rotation and deleveraging event.
Okay, so let's map out where the pain is, the losers. If you're looking at the terminal, AI and semiconductors are taking the hit. The SMH is down 1.20%.
Yeah, that hurts.
The May GS ETF, tracking the mega-cap tech giants, is down 1.31%. The losers right now are high beta tech, unprofitable growth, and these super crowded trades.
Oh, and long-duration bonds are also suffering. Because in a deleveraging event that isn't a true recession, inflation expectations don't drop fast enough to justify holding long-term paper.
Right. But capital has to go somewhere. The funds liquidating their tech names are deploying that cash elsewhere. Where's the opportunity? Who are the winners?
The flows are moving directly into the old-school economy. This environment is highly bullish for financials. The XLF is actually up 0.94% today.
Wow, catching a massive bid.
We are also tracking aggressive accumulation in energy, value, and quality companies with bulletproof cash flows.
What about fixed income?
Capital is hiding at the short end. Short-duration bonds and the U.S. dollar become the ultimate safe havens, while the broader market digests the tech deleveraging.
It's a fascinating paradigm shift. So let's recap this whole journey. We started with AI models completely split on whether June 9, 2026 was a risk-on or risk-off day.
Straight down the middle.
Right. But by digging into the crosstab synthesis, we bypassed the AI blind spots and discovered the hidden truth. We found a calm bond market masking a violent late-cycle tech unwind and forced deleveraging beneath the surface of the stock market.
The car is moving at 20 miles an hour, but the tachometer is absolutely redlining.
Exactly. Which leaves us with a final lingering thought for you to ponder this week. We know that corporate credit markets are currently mispriced. They are completely ignoring the screens of the equity market.
Whistling past the graveyard.
Yeah. But given that credit is the foundational bedrock of the entire financial system, what happens to these stable macro conditions when the bond market finally wakes up and realizes the stock market was right all along?
When that slow-moving tanker finally turns, the real volatility begins.
Keep your eyes on those credit spreads. Thank you so much for joining us on this deep dive. Keep questioning the surface level data, and we will catch you next time.